G'day, I'm Motley Fool Australia General Manager Adam Surplus, and joining me as always for Motley Fool TV is our Chief Investment Officer Scott Phillips. G'day, Scott.
Adam, g'day viewers. Thanks for spending some time with us.
Very good. Now we are live, so feel free to ask questions in the YouTube chat at any time. But remember, Motley Fool Australia is licensed to provide general investing advice only. We can talk about companies, we can talk about economic conditions, we can even gaze into our crystal ball, but we cannot give personalised investing advice. Now, moving right along, Scott, in what can barely even qualify as news because it was so widely expected that the RBA kept official cash rate on hold on Monday. However, as always, and we always play this game, so let's play, it was the governor's guidance which provided the real story. So what's your assessment on that rate decision, and what's your non-forecast for 2026?
Every single time, Adam, every single time I will say I won't give one, but I will talk about it. So you know what was fascinating about the RBA? I'm going to read some of this, and reading's not much fun, but I'll do it very quickly because it was worth kind of going through. When they handed down the monetary policy decision, they give a short statement. We had the minutes themselves, the bigger stuff in a couple of weeks' time. Here's what they say, and it's stick with it, it's not that long. While inflation has fallen substantially since its peak in 2022, it has picked up more recently. Now we know that. The board's judgment is some of the recent increase in underlying inflation was due to temporary factors, so that's meaningful, and there is uncertainty about how much signal to take from the monthly CPI data, given it is a new data series. Nevertheless, the data do suggest some signs of a more broadly based pickup in inflation, part of which may be persistent and will bear close monitoring. Now, I'm going to say you could have written that paragraph and said, and therefore we're increasing rates. Now, if you're a mortgage payer, you breathe a sigh of relief on Tuesday, and fair enough too. But inflation's 3.8%. Now, they do say, well, the RBA's monthly CPI, it's new, who knows? The thing is, the RBA has been monitoring this, creating this for 14 or 16 months. They've had the quarterly numbers coming out, which themselves have kept increasing. Now, I'm not going to give the RBA too much grief, right? There's the old story, the old line is, central bankers have forgotten more about monetary policy than the rest of us will ever know. And there's some justice to that, right? There are centuries of combined experience in Martin Place in Sydney, where the RBA has its headquarters. And I'm not going to second guess them necessarily and say what they should or shouldn't have done. But if you take the view, firstly, it might be persistent. Okay, that's bad because it's 3.8%. Secondly, you say, well, the data series, not sure how much to take from it. That's okay if you say maybe it's too high. But if you're saying we don't know whether to trust it, the alternative is also maybe it's too low. In which case, you don't have much choice other than to say, well, we don't really know. So all we can do is work on what's in front of us. You don't get the luxury of saying, well, it can't be any higher, possibly lower, therefore we don't do anything. If you're saying it could be wrong in either direction, in which case inflation might be higher than reported. Now, the temporary inflation they talk about is, again, somewhat justified, except when they were increasing rates way back in the day, post-COVID, they kind of said, with this international inflation, we don't want it to become endemic domestically, so we'll stop it. Endemic means effectively it goes from this, outside influence, maybe it's around for a bit, but does it stay? Is it persistent? And so you read that statement, and I'm genuinely surprised if that is their view, they didn't increase rates. I don't know. Again, as I said, I can only believe they sat around the table and they care, right? They care a lot. There's a lot of conspiracy garbage going on about the RBA and a lot of kind of, oh, they don't care about this, they don't care about that. It's absolutely not true, right? They care. They're not there to make things harder for everybody. So I suspect, honestly, what they've done is gone, this looks bad. Maybe it is bad. Maybe we just kind of cross our fingers and give everyone a couple of months and hope. And I kind of think, I wasn't there and I don't want to put words in anyone's mouth, but I kind of figure that's the most likely version of what that meeting was like, was, gee, it's scary. Gee, it looks bad. Maybe it's not as bad as this. Maybe it gets better. Maybe we can afford to wait. Gee, if we don't have to put rates up, we probably shouldn't. Okay, let's not. And I get that. I understand if you got the decision to do that to 8 million households in Australia and 2/3 of owners or mortgage payers, so maybe it's not 8 million households and influencers, maybe it's a few million. Either way, you know that if you press that big red button, you make things a lot harder for a lot of people going into Christmas. So I get the concern. I get the desire not to do too much. My only thing, I guess I'll say on the back of that, is that's exactly what Phil Lowe did way back in the day when he said, let's not increase rates, maybe it's transitory. And it wasn't. And so now we had higher rates for longer because they all of a sudden had to recognize this is actually a problem. And I really, really, really hope they're not repeating the same mistakes. And here's the other thing, and this makes me unpopular, and I will say I don't care. I mean, I do care. No one likes to be unpopular. But my job is to kind of tell the truth as I see it. I might be wrong, but I'm not going to sugarcoat it because I'm trying to curry favor with anybody. When you think about rates and inflation, I've said this before in this forum, I've said it plenty of other places, on TV, on radio, and till I'm blue in the face. Interest rates go up and down. Inflation goes up and goes up and goes up. Because even if the rate comes down from 3.8%, which it is now, maybe it comes down to, let's say it comes down to 1%, which would be brilliant, right? Let's say it does. All that means is prices still increase just by less. It doesn't mean prices come down. It means the rate of increase comes down. Now, we're already sitting on the best part of 25, 27% increase since 2020, and another 3.8% this year, and maybe it continues. And yes, I get it. Rates are one of those things where Michelle Bullock's job is to either pull the lever forward, backwards, or leave it where it is, right? And when she does those things, we look around and go, she did it to us. She's the bad lady. She made me hurt. She cost me more on my mortgage. She could have not done it. She's making things worse. Can't she just leave me alone? And so I get it, right? Because there's that idea of like, well, you can blame someone, and that person took a deliberate and specific action that caused a very deliberate and specific piece of pain for anyone with a mortgage. So I get it, 100% get it. The thing is that inflation feels amorphous and like no one's really responsible. It sucks. And maybe it's those bloody supermarkets, or maybe it's the bloody insurers, or maybe it's someone doing something, but I don't really know who it is. And it's kind of everywhere and it sucks, but there's no one particularly to blame. So you kind of feel like that's not okay, but almost like, well, that's going to do it anyway. At least let's control the things we can control and keep rates low. And I guess I want to make the point that if we take that view, by the way, we end up with 25% inflation over the last 5 years. That's what happened, right? That's exactly what happened. Rates were too low for too long. There was too much money in the economy, and everything now costs a quarter more than it did 5 years ago. And so it's a long run up, Adam, just to say that I get it's so tempting for us to say the RBA shouldn't do this to me because it might hurt. When prices keep going up, they won't come back down. If rates go up, they'll stay high. They maybe go a little higher, and then they will come down because that's what happens. So rates go up and down, inflation goes, or prices go up and up and up and up and up, and my arm's not long enough to go up any further. That's why this is such a big deal. And it's why when you look at it and say the RBA is good, the RBA is bad, remember the job they've got to do. And remember what happens if they don't do that job when it comes to every single bill you pay: petrol, energy, housing, rent, food, clothing, the lot, right? Dental surgery, physiotherapy, choose your coffee, choose your topic. And so it's really, really, really important. Now, Matt, you asked me to make a forecast, so I'll go to that because I should. And by the way, it gets me on to the next topic. I don't know. As you know, I'm not going to make a forecast. What I would say is I don't know how a central bank with 3-point-something% inflation for any length of time doesn't put rates up. I can't imagine a scenario in which that happens. Well, actually, I can. They've got to do one of two things. They've either got to say, inflation is our mandate, we're going to do something about it, or they say, we're not going to do anything, we give up. We're not going to do what needs to be done. We're simply going to squib it. And I don't think they're the RBA, they're not going to do that, right? They're just not. Well, again, strange things have happened, right? Pigs might fly. So will it happen? I doubt it. It could. And if they don't squib it, they have no choice. As reluctant as they might be doing, I said this time around, let me be really unpopular, mate. If I was in that room, I'm putting my hand up for a rate increase. Not because I want to make things harder for people, because I want to make things better for people over the long term. I want prices to not increase. And by the way, when they go up, they compound. We all know compounding, right? We're investors. Prices compound too. So the longer you let them go up, even when next time's 1% increase is effectively 1.25% compared to 2020, because we've already got this higher base, right? So it's really painful. So unless we're all incredibly lucky and inflation somehow miraculously falls suddenly, and that if you have a God, pray for that, because that's what changes things, right? If that comes down, then all bets are off and we can go back to the drawing board, and that'd be wonderful. If inflation's 3-point-something when we get the next lot of data in a couple of weeks' time, and we get another lot of data after that before the RBA meets again in February, you've got 2 more months of something higher than, I just don't know how they do. I don't, again, I'm not going to predict it because I don't know what the data will do. And even if I think the RBA should do something like I did this time, they may not do it. I don't know how they can avoid putting rates up in February unless inflation is just somehow magically and miraculously Christmas time. Maybe it's time for Christmas miracles. But without that, I don't see how they don't. And if they do squib it, then we're paying higher prices for far, far longer.
Yeah, and look, you and I have been around for a few RBA governors. It seems like they go through this process. You know, Michelle Bullock was very sort of cautious the first sort of 12 months. And they go through this process where they kind of seem to discover they've got the lever, which is the interest rates, cash rate, but then they've got this sort of other lever, which is how close is the hand getting to the lever? You know, how strong is the language? And I think obviously Philip Lowy pushed that a bit too far, famously. But you know, do you get a sense that they're trying to use that secondary lever? You know, by being, you know, using stronger language and sort of being a bit more direct in their, I guess, their commentary.
Yeah, that's a great point, man. That's one I should have made. So I'm glad you mentioned it. Yeah, the old jawbone, right? Jawboning the economy. Yes, 100%. I mean, effectively, before they increased rates the first time or last time around, they kind of said, hey, if nothing changes, we're going to put rates up. Hey, if nothing changes, we're going to put rates up. And they kind of then went, well, we told you if nothing changed, we put rates up. So yes, I think you're 100% right. And we're in the financial markets, right? The RBA cares way too much about the financial markets. I got to say, as much as, you know, gives us something to talk about, and the shiny bums in the CBD glass offices, oh, we have to have something for the RBA so we can put something in our forecast and all this kind of absolute garbage. It's all about the physical economy, right? The financial economy, who cares? You know, like it should be and will be a function of the physical economy. So that's what matters. But Reserve Bank governors for too long have seen their job in part as providing commentary to help financial markets do their thing. I think it's garbage and they've absolutely captured, right? Not in a nefarious way, just like they're falling into this trap of feeling like they need to please. And, you know, they're public servants, so they've got to serve us. They don't have to please us. They're different things. So I think that's true, but and that's why it goes to your point, which is really important. And, you know, I said the first paragraph of the statement is basically a statement you'd give if you're going to increase rates. And they didn't. So what does that say? And again, I should have mentioned, I'm glad you asked. That pretty much says, hey, she's setting the table. Michelle is absolutely setting the table to say, all right, we haven't done it yet. Now we're telling you things have changed. And now we're telling you we've got to, what was the phrase? We'll bear close monitoring, right? Which is basically, we're watching. And if it doesn't change, well, what do you expect us to do? So yeah, this is, again, they shouldn't feel at all obliged to give me or you or anyone in the financial markets or anyone anywhere some sort of heads up that in some point in the future we'll do this thing. Do what's right when it's right. If you haven't given us notice, who cares? Do it because it's the right thing to do. Now, I'm not saying they haven't done that. I'm just saying in that context, please don't feel like you got to butter us up for a month first. But I kind of think that's exactly what they've done. They've pretty much said, this is rubbish. This is bad. If it's still bad, it bears close monitoring, right? Which is central banker speak for, yeah, we'll probably have to put rates up. And so I think that's absolutely right. They've set the table for this one. The markets are already responding, right? It's already been priced in for February. I'm not saying it will be, because we don't know what inflation will do. Famously, 3 or 4 months ago, we talked about it at the time on Motley TV. Everyone said, oh, they're going to increase rates or decrease rates. They're going to drop rates. There was 95% chance, according to the bond market. The average didn't do it. I thought that was brilliant. Not because I want to necessarily thumb my nose at the bond market or some of our peers in our industry. More just the idea of just because you guys think they should doesn't mean they're going to. Just because they're going to doesn't mean they will. And so that stuff is, I think, really, really important. I love an RBA who says, no, we don't care what you think. We don't care what we've said before. We're going to do what's right when it's right because it's right. That being said, I think they should have that this month. I think they're absolutely setting the table for the preconditions for, and look, frankly, when we get the November inflation numbers in December, when we get the December numbers in January, the table's well and truly set. If those are too high, the RBA has almost got to walk away from its mandate not to increase rates if it comes to it. And again, let me say, I don't want people to pay more for their mortgages. I'm not here, rub my hands with glee, thinking how wonderful it is. Everyone's going to really be hurt. It's far more important that you're hurt for a bit in the short term. It's the old investing thing, right? Short-term pain, long-term gain. If they manage inflation properly, that's exactly what we get and exactly why we should bear that short-term pain, because the alternative is some short-term gain for some longer-term pain.
Yeah, no, it is interesting to see the press and the pundits basically arrive at a decision themselves and decide that it's inevitable.
That's right.
But
That
anyway,
doesn't happen.
that's right. Yeah. So
Yep.
there's another number which they can decide all they like that is not inevitable, and that's GDP. So.
Yeah.
You know, we've had the strongest annual GDP growth in the past 2 years, but we've also just had the softest quarter. So does that sort of indicate that we're you know, heading into another trough?
And that juxtaposition is really, really important, right? And you know, this is what I mean. I hope we're not the only people out there doing it, but I do think, you know, we have zero conflicts, right? We don't get paid by anyone except our members. We get a little bit of advertising for the podcast. I'm pretty sure that's about it, Adam, as far as I know. So we got no one to please except our members, right? And we please our members hopefully by picking great stocks and helping them win. So that's the first thing, but also by telling them the truth. You know, the Motley Fool itself, the Shakespearean character, the multicolored court jester, the Motley Fool, that person's job was to tell the king the truth. Now, you do it with a bit of wit, bit of humor, hopefully. I'm not saying I'm necessarily doing either of those two things, but you do it in a way that doesn't necessarily get your head lopped off, but you tell the king the truth, right? And that's what we've always tried to do. Now, what it means is we get to hopefully do some of that in the face of relentless spin from everybody, from the politicians in government, the politicians in opposition, from business groups, from unions, from whatever. And sometimes that means half the people hate us and half the people love us. And then we say something else another time and the other half hate us, the other half love us. And that's just kind of life, right? By the way, it's not that, because most of our members, all of our members, I hope, or certainly anyone watching, hopefully is doing it because they want us to give it to them straight rather than just sugarcoating it. So why do I say all this? Because 2.1%, strongest in 2 years, was the headline from the boosters, right? Those who want a glass half full, which I am, frankly, those in government, those who want to say the economy is doing wonderfully, you say this is the strongest growth in 2 years. Now, I will say, if 1 year is the strongest in two, not exactly not a wonderful deal, is it? If I said, look, I had the best night's sleep I've had since yesterday. Okay, it doesn't tell you much. If yesterday's sleep was rubbish, having a better one's not that good, right? So best year in two is not particularly flash. It's better. I'd rather have the best year in two than the best year in one, because, you know, at least we're doing something better. The problem is that over the last 4 quarters that make up that year, we had, and I can't remember the sequence, it was 0.5 or 0.7. I can't remember which. I'm going to say 0.5, I think. 0.5% growth, then 0.4, 0.7, 0.4. Now, so we've got both at the same time the best in 2 years, but the last quarter's growth was the weakest, the equal weakest this year. So on one hand, you're saying, well, things are improving. Best in 2 years, obviously we're on the upswing. Look at the quarterly number. It's like, oh, dude, it's worse than the previous quarter. It's worse than the quarter 3 quarters ago. And it's no better than the one half a year ago. So what are we saying? We're saying, geez, things are not exactly scraping along the bottom, but not wonderful. In fact, if you annualize the last quarter, and you can't just do that directly because things happen, seasonality happens, and inputs and, you know, influences happen. But 0.4 times 4 is 1.6. These are not good numbers. Now, the best thing you can say, frankly, and this is, we're in this weird space where the best thing about low GDP growth is it's not adding extra inflation pressures to what's already overheated prices. The economy is growing at 3%, and we're looking at 3.8% trailing inflation. You're like, oh man, this is ugly, right? We've got demand coming up with the wazoo. And we've already got prices that are higher. What's going to happen? They're probably going to push even higher again. So the best you can say from low GDP growth is, at least, thank goodness, it's not pushing inflation even higher than it would otherwise be. So that's really good. The other number, by the way, it's really important to focus on is the per capita or per person GDP. Now, what is that? If you're not familiar with the data and the jargon, there's the total gross domestic product, right? Gross and then total. Domestic, stuff we do internally, product. And to be honest, these are product and services, but we still call it GDP. It's the output of the economy, all rolled together. And we made 0.4% more in the last quarter. So that's, I mean, it's better than going backwards, right? The problem was the population grew by about the same amount. So for all the extra effort, for all the extra output, for all the extra work and tax and administration and getting up early and going to bed late and putting your effort in, we kind of went nowhere. Per person on average, we didn't improve things at all. So what was all the hassle? What was all the work for? And I've used the example, excuse me, before, if it helps to put per capita in context. Imagine going to work and the boss says, hey guys, great news, everybody. The wage pool, the total wages are going up 5%. Everyone goes, oh, that's wonderful. And the boss says, thing is, there's 10% more employees, so you're all getting less each. And that's kind of, that's the per capita. Now, we're not getting less each, we're getting exactly the same. So in the example, it's, hey, good news, everyone, wages are up 5%. Wonderful. We've got 5% more employees. So does it matter that wages are up? No, it doesn't. It really, really doesn't. Now, maybe the business is healthier overall, so maybe there's something there. growth is better than not. So I guess there's something there. But remember, these are the numbers. So let's break down GDP. I'm glad we're growing. I'm glad, frankly, it's better than being higher than last year rather than lower than last year. So those are two good things. The last quarter, pretty anemic. The fact we're not growing per person, very, very, very ordinary because we're not getting ahead as a society at an individual level. As an investor, I love the fact that Woolies sales are growing. I mean, yeah. So purely selfishly, if the economy grows and Woolies, I don't own Woolies shares, by the way, but if I did, Woolies grows, maybe make some more money. So I'm probably pretty happy about it. Economically, overall, are we healthier as a country? No, we're not at all. And that's in the short term, me being happy about Woolies selling more stuff to more people is wonderful. In the medium and longer term, if we can't find economic growth more broadly, then we're kind of a bit, I won't say sick, but we're kind of muddling along, right? And when you're not growing, I won't say you're dying, but you're in if you're a sailor, right? You're in the lead. There's no wind either direction. You're just kind of bobbing along, and that makes you vulnerable. And so that kind of is worth just thinking about a little bit. Sailing's a great example, right? Sail too fast, you hit a whale. I'm not a sailor, right? But if you're going too fast, you're massive amount of risk. If you're not moving at all, you're at risk of capsize, a big wave, or whatever. You want to be moving at a solid, steady pace towards your destination. And we're just not doing that, at least not to the degree we want to. I said, good news, we're not putting more pressure on inflation. Bad news is, if you're having inflation, you at least want growth. Well, I'm paying more, but at least I'm getting more. Right now, we're paying more and getting the same. And that's kind of, when you look at it, that's where that's the crux of the problem. Productivity, by the way, is the other thing we'll talk about another time maybe, but that's how we improve GDP per capita over time. That is the big question of our age, is is it possible to get productivity improvements in an economy like ours, which is already very mature, already very services-based? What do we have to do? And governments can't just press a switch. It's not just them. It's not just business either. But productivity is how living standards improve. It just is. I don't have the time to go through it now. I mean, I do, but I'm not going to waste everyone's time. Productivity is how you do it. That finding that magic is how you get the economy to grow, how our standards of living improve.
All right. Well, one thing, before we move on, actually, I will mention, maybe don't ask any sailing questions in the chat. One thing that may actually save us in the short term, at least, and we don't normally look at the short term here at Motley Fool because we're long-term investors, but Christmas is coming, so let's have some fun. We always hear talk about the Santa rally. It's kind of, we're getting pretty way through December already. We might be running a bit short on time for a Santa rally, but talk us through, can we expect one? What are the causes of it? Why does everyone always talk about this Santa rally phenomenon that happens in December?
I love that, mate. By the way, over the last month, the market's down 2.65%. So if it's going to come, again, if you want to pray to a God, if you want to pray to Santa, write a letter to Santa, ask me to bring you a rally for Christmas. I'd be very, very, very grateful. So what I love about investing is it's part art and part science, right? And the science part is pretty straightforward. We've got spreadsheets on spreadsheets on spreadsheets. If you've got a Motley Fool investor team meeting, there's a lot of talk about ratios and numbers and stuff, and that's great. There's also, and that's the science bit, that's the maths bit. Numbers are numbers are numbers, right? Well, 2 + 2 is 4, no matter which way you cut it. The art bit is a little bit of a combination of, firstly, thinking about what the future might hold and being able to deal with that gray area of no one has the crystal ball, but what things are more likely to make a company successful or continue to be successful over time. That's kind of useful. The other art bit is psychology. And it's all about what humans do, how they act, how they think. And at the end of the day, our job as investors is to find things that other people don't like that we think they're wrong about. That's exactly how you make money. Because if we like it and other people already like it, you don't get it for a good price. If we don't like it and they like it, well, who cares? And if we like it and they don't like it, that's the opportunity. Now, what comes with that is, I like it, you all hate it. Okay, fine, that's how we start. You're not going to change your mind because I bought the shares. And that's why often you buy shares that keep going down. Why? Because no one picks the bottom. It's not possible. Right? Don't try. It's just not possible. So you buy shares, go, I like Woolies. Again, we'll use the example. I like Woolies. Everyone else hates it. They think the business is dead. It's not going to grow. By the way, right now it's not miles from. They don't hate it, but Coles is giving it showing it a clean pair of heels, and you go, I think Woolies is actually probably going to recover from this. Let's say that's your view. But Coles are still winning. And investors are still looking at Woolies going, I don't want to buy that. That's not going anywhere. And so for a while, maybe even for a long time, you're friendless and the shares are friendless. And you think, what am I doing? I thought I was right. I bought the shares. They keep going down or they haven't gone anywhere up. I must be bad at this thing. And you've got to remember that what you're waiting for is the business's fundamentals to demonstrate that you were right. Assuming you are right, demonstrate you were. And when they demonstrate that, investors go, huh, oh yeah, I'll buy Woolly shares now. The benefit you go is like, hey, I've already got them. When everyone else starts buying, I get the benefit of rising share prices. That's really, really nice. Why do I mention all that? Firstly, it's important in its own right. So I hope there's some teachable moments in that one. The more important one in the context of the question, though, is what's the Santa Claus rally? And it kind of comes back to investors in the past who there used to be what they call a January effect, where shares tended to go up in January. And it happened often enough, or it was perceived to be happening often enough. Again, don't forget, it doesn't matter whether it's real or perceived. As long as people believe it, that's enough. That pushes prices up. So there was this January effect, right? I don't even know the history of the January effect. I should look it up. Anyway, what happened was everyone would watch this January effect, and shares would go up in January, go up in January. And then people started to think, hang on, if shares always go up in January, if I buy in December, I can front run this. So what happened? People started buying shares in December. What had happened then? Shares started to go up in December because everyone was buying, anticipating a January effect. And so the Santa Claus rally is literally people trying to front run other people who were expecting another rally in January. And then what happens is the January effect goes away because everyone buys in December rather than January. And then what happens is people start buying in November to front run the Santa Claus rally. And it's kind of, I mean, I'm laughing, and it's entirely silly. But also it's the study of humanity. It's the lemmings in all of us, right? It's just that desire to, I've got an idea. They're going to do that. So if I get there first, I'm going to make some money. So the January effect became the Santa Claus rally. The Santa Claus rally kind of bleeds into November because that's where we tend to find, people try and front run that one. There's the old sell in May and go away thing as well. I mean, there's so much stuff. Here's the thing. Humans seek patterns. And as investors, that's really, really, really powerful, like genuinely powerful. Because if I can work out what other people are likely to do, not even other investors, I'm not about guessing share price movements. Think about why people buy Coke, right? What's the pattern there? It's the fact, by the way, got a can of Coke Zero here. I'm going to drink as we chat tonight. Case in point, right? Do I think Coke is objectively better than Pepsi? I'd say I do. Am I really objective or am I subjective? Is it because I like the brand, it's kind of cool, I associate it with good times, with childhood, with other things, everyone else is doing it anyway, blah, blah, whatever it is, right? The psychology of brand, for example, it as an investor is a pattern I can look for. The problem is we also look for other patterns. I will tell you right now, and I'll probably offend some people watching, and if I do, I apologize, although not for telling the truth, just for causing offense. Adam's already cringing. The trading shares based on past share price movements, I think, is seeing patterns that either are sometimes there or are never there, or they're often enough to convince you that maybe there's a pattern. And that is the bit which goes back to what we just talked about with the Santa Claus rally. It is people thinking they see a pattern and thinking other people might see the pattern, and then trying to think, well, hang on, if I think that they think that I think that they think that I think that they think they'll do it. And again, it's as mad as it sounds. And it's why playing those sort of games is, frankly, stupidly hard. Like I said, it's impossible. There'll be someone out there who says they've done it or have done it 2 or 3 times in a row and thinks that tossing 3 heads in a row means it's always going to be heads, or they're somehow wonderful at guessing the toss of a coin. But the reality is, what you're doing is you're trying to basically second guess other people's second guesses. John Maynard Keynes talked about the beauty contest. And the idea was a competition where you had to choose the most beautiful woman. Now, again, it's pretty sexist and it's historical, but work with me because it was the example he used. But the catch was you had to choose whoever else thought it would be. So I'm trying to guess what you think. But if you're guessing, you're trying to guess what I'm thinking you're thinking. And it sounds obtuse, and it kind of is, except when you really think about it. So share prices happen exactly the same way in the short term. When people have price targets for this year, they're not saying, I think the price of BHP will be 12% higher because earnings are going to be up 12% and investors aren't going to change their minds. It's always and ever going to be a small combination or a small amount of fundamental change in the business and a large amount of change in expectation. Look at lithium stocks this year. Look at every story stock almost ever. Look at Drone Shield, by the way. Anybody? So many of those types of examples where everyone gets excited and then everyone gets depressed. And you kind of go, what really changed? On Drone Shield's case, there was executive sales, which we've talked about before. But yeah, so trying to second guess what other people think is just a crazy way to try and invest. It's pure speculation. And if you want to do it, knock yourself out. I don't think it's doable in any repeatable fashion. So back to the Santa Claus rally. Can we expect one? I don't know. More often than not, we get one these days. It's a relatively new phenomenon because people front run the January effect, as I said. And at some point, I would put money on the fact that the Santa Claus rally peters out and becomes the November effect, or whatever we end up calling that. It'll be the Black Friday effect, someone will call it, or the Thanksgiving trade, or there'll be some fancy name given to it. And at that point, all we're really saying is people are trying to guess what other people might do and try and front run those people. Other people try and front run those people, and around it goes. Look, I love rallies because share prices go up, right? It makes me feel richer. The other thing, one last thing, Adam, when share prices go up, you feel richer, but every purchase you make is more expensive. Warren Buffett talks about the fact that it's like people having filled their car with a tank of diesel, and then feeling great because the price goes up. It's like, oh, thank goodness I got my diesel cheap. It's more expensive now. I got it cheap. I made some money. Forgetting that in a month's time or a week's time or a couple of days' time, they've got to refill the tank at that higher price. So if you're an acquirer of shares, you should want lower, even though it hurts your portfolio value in the short term, you should want lower share prices, not higher prices. When you feel richer, that's great. But every dollar you add to the portfolio is buying fewer and fewer shares than it was when the prices were cheaper. So try and keep that in your head at the same time. Be happy about your portfolio going up. Be happier about share prices going down and giving you the opportunity to go and grab a bargain.
All right, well, we should all be stoked because in December, as you said, market's down 2.5%. The ASX is actually down 5% since mid-October.
Yes,
so
right.
I guess that's why you're smiling. A lot of people are not smiling, but a lot of people are also asking, does this mean that the longer term boom that we've been experiencing is over?
Again, I don't know, mate. We'll only know in hindsight. I know this is kind of a bit esoteric, but it's kind of real. Please stop listening to people who think they know what the answer is to that question. Please, like for your sake. It seems smart, right? And who do we remember? We remember the people who make the big calls once. Michael Burry on The Big Short, right? Nouri Urubini was the GFC, I think you might have. And we still talk about these people. Michael Burry shorted AI a couple of weeks ago for about 3 days and then gave up the trade. And yet it was reported everywhere because it was big short guy, shorts AI, and he's a really super smart guy. I'm not bagging the bloke. But when you all say he got one thing right, therefore we should slavishly follow everything he does next, it's madness, right? And people, by the way, other people who say, I'll make a prediction about the ASX or interest rates or GDP or whatever, and they get it wrong. And next week, people say, oh, now what do you think? You were wrong last time. Why would I listen? So please be careful about listening to that kind of stuff. Is the boom over? No. Over the long term. And I'm gonna say, you know what's both great and terrible? People hate the idea of just chill out and do the long-term thing because they want a shorter-term answer. Right? I'm going to say share prices are very, very, very likely to be higher in 5 years' time and even more likely to be higher in 10 years' time. And I can't give guarantees I'm allowed to. I'm going to be a little bit careful how I speak. But in 20 years' time, I will metaphorically walk naked through Sydney if share prices aren't higher than they are today, right? Because markets go up over time. I've done this spiel before. I won't do it in full detail now. You've heard it before. If you want to hear it again, let me know. I'll happily do a separate video on it. Share prices go up over time because human ingenuity, entrepreneurship, effort, invention, discovery, improvement happens. It happens. AI is a thing now. It didn't exist 3-ish years ago. The internet didn't exist 30 years ago. Cars didn't exist a century and a bit ago. I mean, think about the progress of the 20th century to today, that 125 years. Imagine going to 1900 and saying to people, let me sit you down and tell you what 2025 is like. You would blow their minds. And through 1910, 1941, 1972, 1988, 2001, 2006, frankly, the last 15 or 14 years I've been doing this, I get emails saying, oh, yeah, that was the past. Not going to do that anymore. And it continues to go better because things get better. So is the boom over in the short term? I got no idea. Absolutely no idea. And neither does anybody else. I've said before, if they think they do, they're lying to you or they're lying to themselves or both. I don't care which one you want to choose of those two. It's not helping you at all to listen. Why do we listen as humans? Because we hate uncertainty with a passion. And if I can find someone over there who's got a fancy title and a fancy job and wears a tie and sits in an office and works for one of the big companies and says, my forecast is this, we kind of instinctively and even subconsciously suspend disbelief. Oh, good. Jane Smith said it's going to go up 15% this year. Okay, now I know. That's good to know. Great. Okay, good. I can do something with that now. Does Jane Smith know? Of course she doesn't. No idea at all. She might get lucky. She might be right. She might be right once, maybe not twice, maybe not 3 times. So is the boom over? I have no idea. What I do know is that what I love about, as I said, capitalism and like lower C capitalism, let's not get caught in this definitional stuff, is I've already said things improve over time because I've said, here's what I've said before, I'll say it again. If you think capitalism has reached its peak, if humans have tapped out, if we've hit the ceiling, sorry, we got to 2025 and nothing ever got better after that, then yeah, sell your shares. Go spend it all on something exciting and then go and find a cave, right? If that's your view, I'm not, you're entitled to it. I'm not going to tell you, well, I will tell you I think you're wrong, but I'm not saying you are wrong. Or if you think that between now and 2035 and 2045, we invent new and better ways of doing stuff, and that creates more value for society. I mentioned productivity before. If that creates more value, it'll create more companies make more money. I mean, NVIDIA, right? Is it still $4 trillion market cap? If it's not, it must be very, very close. This thing's up 15-fold in 5 years or something stupid, right? I say stupid, I don't mean necessarily unreasonably larger. I just mean the growth of AI has just propelled this thing to the moon. Who saw that coming? I mean, some people say they did. Maybe they did, maybe they didn't. My broader point is you don't always, very rarely see it coming, but things improve over time. Long way to answer your question, Adam, which is to say I don't know whether the boom is over or not. As I said, I do like cheaper share prices. I hate on behalf of our members they feel bad about it, and I hate that people give up investing, and I hate that people think I've lost money, so I'm going to sell, and I hate that people think why did I bother? Or I'll never start, or whatever else people think when the markets go down in the short term. Because we've seen the Vanguard chart. I'll finish with this observation. The Vanguard index chart I've talked about a gazillion times. If I was on a commission, I would not be working. I'd be on the beach in the Bahamas. Single chart, bottom left, top right, really squiggly, but gets there. Turns 10 grand into 130 odd grand. I can't remember the last recent numbers. Last year's numbers were 10 grand, 130 grand in 30 years. 13-fold increase in value. How many times did people ask, is the boom over? How many times did people ask, is the crash going to continue? How many times did people say, there might be a recession, you know? How many times did people say, gold's up, gold's down, copper's up, copper's down, the market's up, the market's down, interest rates are up, interest rates are down? A gazillion times during that period of time. And yet 10 grand becomes 130 grand over 30 years by doing literally nothing. Now, when I say that to people, a small group of people say to me, yeah, you can't use that as an example. Who'd do that? And my head explodes because I'm like, that's the point. That's what I'm trying to tell you. If you're someone who says, oh, people won't do that, then do it. Be the person who gets that return, right? Now, that was the past. I can't promise it's going to be in the future. You know all the usual legal restraints I've got about what I can say about the future, and I wouldn't promise anything anyway because it'd be unethical to do so. But do I think human ingenuity is tapped out? No. Has invention stopped? No. Have we stopped discovering, collaborating, designing, improving, becoming more productive? No, not by a long shot. So I don't know whether the boom's over, mate. I'd love to know. I am happy to buy shares while the share prices are lower. I bought some not that long ago. I'll buy some more pretty soon. Why? Because shares are cheaper than they were. Now, I'm not saying just because they're cheaper. If they were overvalued, then they're probably still overvalued now. But if I liked something at $100 and it's on sale for 95, it might be a big discount, but it's better in my pocket than someone else's.
Very good. Okay, let's get down into the weeds now. And we have a question about corporate travel management. Sorry for bringing it up, Scott. Don't be sorry. That's what we're here for. But can you please comment on the corporate travel management situation, the way it's been handled by management, if news out recently is correct? I think Steve Johnson from Forager reckons that the shares will never trade again. But yeah, the company could become insolvent due to reparations required, or at least suffer reputational damage that provides a thesis breaker. I'm glad you used that word. What are your comments, Scott?
TC, I should refuse to answer on the basis that you use the ticket code rather than the company name, but I won't because I'm a nice bloke.
I'll let him go. I'll let that one go through the keeper.
Yeah, I noticed that.
It's brevity. He's already taken up 2 questions to ask us. So we'll forgive it this time.
So, speaking of things we don't know, I don't know what happens next for corporate travel. I own shares. We've recommended them. The Motley Fool owns some shares in corporate travel. You bet I care about what happens next. By the way, I've said this before. My wife's not watching, so that's okay. I care more about our members than my own portfolio. And seeing sounds trite to say, but really, like, I've been through the wash so many times as an investor. I'm cool. What I hate is when a recommendation of ours goes bad and people think, well, I'm going to give up on investing. I'm going to give up on the Motley Fool because the one company went badly. It's going to happen, right? I can't stop it, but yeah, I genuinely feel bad about it. So For 14 years, the auditor said nothing to see here. The company delivered their accounts. The auditor signed them off. The company's directors signed them off. Said, this is good. This is all fine. Now, no one ever promises it's perfect, but they all say, based on our best endeavors, we think this is fine. And the auditor turns up and says, guys, we can't make these numbers add up anymore. Now, I got to say, we don't know what comes of this, Adam. So I'm going to be really careful, right? Because there's allegations and reports, and we don't know yet what, if anything, will go to court, who might be to blame. And I'm not going to get myself or the company in trouble by making allegations or accusations at anybody at all. What we know is they were signed off as clean and good for years. All of a sudden, new auditor turns up, as I said, and says, guys, this doesn't work. Now, how on earth a previous auditor doesn't manage to find what the new auditor found in one audit, I am staggered by. So you bet I'm grumpy, right? Now, we also don't know what the management of the company knew and when they knew it. They've stood aside the head of their UK and Europe operations. They have made no allegations or accusations against that person, so I'm not going to do it either. Maybe it was one person. Maybe it was a team. Maybe it was a company. We don't know at what level this was known or could have been known, what was done correctly or incorrectly, what was signed off or not signed off. That's going to come out. The fact that this has taken now, 5 months in, I think, to the suspension, and it's not going to come out to probably January. Because I'm an optimist and because I'm looking for the silver lining, by the time these numbers are reported, they are going to be the cleanest set of numbers in corporate Australia, right? Because and nothing could take 6 months unless you literally go through almost line by line by line, almost invoice by invoice, and say, show me the detail, show me the detail, show me the detail, show me the detail. Now, we don't know what they're doing behind closed doors. And TC, this is why I'm going to hedge my answer a little bit, mate, because I don't know what comes next. Everyone's speculating about how much this might cost. The company has undrawn credit lines. There is some talk that the reparations may be more than their cash balance. They may need to tap that. There may need to be an equity raising. I haven't seen the reports from Steve Johnson, but I like the bloke. He's a smart guy. Maybe that is the case. Maybe the company gets sold off, run down. Maybe it goes into administration for all I care. I'd hate to think that was possible, but it's possible. The reason I can't give you, two reasons. There's no point in me giving you a view because the shares are suspended. You couldn't sell the shares even if you wanted to today. But second, we don't know what the auditors will eventually find, what the company will eventually announce, what the implications are going to be for the shares. We don't know. We can't know. And so it's a really awful, unsatisfying answer, TC. And it's one we've been grappling with internally for our services for ever since that happened, right? At first, it was maybe it's revenue recognition. In other words, the revenue should have been recognized in one year, but it was in the other year, just some accounting changes. That was the original expectation. Then it became maybe we've overcharged some customers. Then it was, well, we're checking everything to make sure nothing's going wrong anywhere else. Now we've got other customers. You mentioned reputational damage. I'm not going to say it's the biggest issue because it may well be existential if the amount they have to repay across the board is huge. But at some level, there may well be a case for customers saying, well, if I can't trust you, I'm walking away. Now, I had this conversation with our team literally today or yesterday. We don't know how many customers. We don't know how broad or narrowly geographically or by business unit that sits. We don't know the total dollar value of what's going on. We don't know who knew what and when they should have known it. In a perfectly wonderful situation, there are 3 people in the UK involved. The auditors were irresponsible and we go, right, it's this much money, it's quarantined, and we all get on with business. The restated accounts come out and it's lower, but not meaningfully lower. The share price will fall because people just will freak out, and that's kind of what they do. I mentioned sentiment before, and we all get on with it. The worst case scenario is this is a global problem. There are people involved who shouldn't have been involved, who should have known better. There was something systemically wrong with this one, and at some point, the business ceases to trade as we know it. And you bet that's a really uncomfortably large range of outcomes, TC. So I don't know, mate. I wish I had an answer for you. I wish I had an answer for myself. I wish I had an answer for our members. What I will tell you is we're not going to jump at shadows. And this is also really important, right? So in times like this, it's tempting to want to just cauterize the wound. It sucks. It's awful. Can we just make it go away? Because then I don't have to think about it. I don't have to feel the pain. I can, proverbially turn the page and move on and pretend it never happened. That would be the wrong approach. Now, we may end up, on behalf of our members, selling those shares. By the way, I've said, if we do recommend members sell, the Motley Fool won't sell for at least 2 days. I won't sell my shares for at least 2 days either. So members always go first to the Motley Fool, and we'll always go first to the Motley Fool. Maybe that's what we come to. What I won't do is say, this hurts, I just want out. because that is not a rational, sensible thing to do. Let's say the shares fall to $1, right? I don't want to think about that. But let's say they do fall to $1. Maybe they said they may not trade again. Maybe they're not worth anything at all. We don't know. Let's say they fall to $1. If I reckon the shares are worth $2, I'm not going to sell them. They're still a long way down from where they are today. But if they're worth more than the price they're trading at, it'd be madness to say, well, I'm giving up the difference and walking away. Now, if they're worth $3 and they sell for $3.50, I'll sell. But the only job an investor has to do is say where to from here. And members can make their own decisions. We don't manage their money for them. If they say, Philip, you're an idiot, this sucks and I hate it and I hate corporate travel and I hate what they've done to me and I'm emotionally going to say just pitchforks and hatred and I'm out of here, that's okay. It's everyone's choice. My job is to be as rational as I possibly can and say, well, picking through the wreckage, what can I salvage from this? What would I pay for the wreckage that's in front of me? That's the only question I have to ask, the only question I have to answer on behalf of our members, and that'll be the effort we go to. Right now, mate, again, one last time, I can't give you a view because we just don't know. We don't know what the auditors will finally find and recommend. We don't know the financial impact on the company. To your point, we don't know the reputational impact on the company. We don't know the management impact. How high does this go? Who is involved? Who should have been involved? Who can fix the problems? We just don't know. So, mate, that's a really deeply unsatisfying answer. It is, I mentioned before about not giving you, no fear or favor. I can say lots of things. I could blow up about management, like, we're going to sell and they can go to hell and whatever else. There's, again, the investing is about vengeance. It's not about victory. It's about buying something for less than it's worth and selling it when it's selling for more than it's worth. If we get that opportunity, we'll take it in a heartbeat. If we get the opportunity to buy more or simply hang on because we think the market's overreacted, we'll do that too. And that's not going to be comfortable. But if you're there to make money, I mentioned at the very beginning, it wasn't intentional, by the way. That's what we're doing. We're saying we think you are all wrong. Every time you buy a stock, that's the only thing you're doing. You must say that. If you say, well, you're all right, you're not getting a good price. You say, you are wrong. I think the shares are worth more than you do. That's why I'm buying and you're selling. So long answer, but it's worth, I hope, that amount of time and effort to explain the situation and to say, frankly, outright, I do not know because we haven't seen the numbers for the company. As soon as we do, we'll formulate a view and we'll let our members know.
Ice cold. Okay, we've got a really interesting question from Jake here. So Jake's asking about Zoom stock. So Zoom, the tech company listed on the NASDAQ, and Adore Beauty listed on the ASX. Wanted to check if they're both still quite liked. Look, on the surface, these are two very different companies. However, they are both COVID stories, aren't they, Scott?
Yeah,
and I'll leave it up to the viewers to decide which of those two companies we use on the daily. But we do, and I quite like the product. Zoom, of course, I'm talking about.
Oh, I do.
I think
well, it must be different people, Adam.
That would be an indictment on the beauty company if this was the result. But yeah, look, both very similar stories. And look, Zoom is a great product. I don't know much about Adore Beauty, but what's your assessment of these businesses now, having been through these stratospheric valuations, which were clearly never correct?
Correct, 100%. I own Adore Beauty shares. I don't own Zoom shares. So for full disclosure, that's where we're at. You're right. They're both. I love that you drew that link. They're both absolutely COVID stories, right? And the investor's job, if you're a speculator, if you're a trader, you're trying to say, I think people are going to pay more for this in a week's time or a month's time or a year's time. And why would they pay more for it? I don't know. You might have a story in your head and you might sell when you say, well, I don't think that story is true anymore. And in hindsight, I would have loved to have played that trade for Zoom and Adore Beauty because they had spectacular COVIDs and then spectacular falls thereafter. The only question for the investor is not what did the business go through, but where is the value? And I say that because I'll give you an example. I used to own Blackmore shares. And you remember the Daigou trade, that idea of the suitcase trade? A lot of Chinese expats, tourists coming to Australia, or Chinese students here, Chinese residents here, sending boxes and boxes and boxes of baby formula and vitamins back to China, and they'd be distributed amongst the network, the kind of friends and family networks in China. And that was I don't remember what Daigou means actually in Chinese, but that was the Daigou trade. Blackmore was about a fortune during that very short, or relatively short boom. And then the shares and the profits fell off. Now, you ask yourself, the profits falling is never good. But if you want to avoid the profits falling, you wouldn't have taken extra sales in the first place. And we think that through and think, well, that's crazy, right? Of course you're going to take the sales when they come. Why are you going to knock back a sale because you might buy from me next year, and so I don't want the profit to fall next year, so don't buy from me this year, please. Of course you're not going to. So they do, and they should, and they did. And Zoom and Adore had exactly the same circumstances. On top of that, though, was that sentiment piece, which is this changes the world forever. And here's why thematic investing is incredibly dangerous. Those two themes, we will use online communication video tools forever from here, 100% right. The idea of we will buy a lot more online in 5 years' time than we are today, including beauty products, 100% right. Those were both entirely accurate and correct ideas. And yet the shares got smashed. I looked just now, Zoom is down over the past 5 years, 78%. Adore Beauty, I'll quickly look up. I suspect something similar, actually. So yeah, 76.5%. There you go. Now, by the way, right now, Adore's still selling at a P of 160. Zoom's P is 17 times. It's cheaper than Commonwealth Bank on a price-earnings ratio basis. I won't bother going to the PE now. We haven't got the time. Yeah, we're running out of time very quickly. I'll shorten this up, Adam. So separate all that out. The question for investors now is, what is the future of these companies based on the current likely trajectory of the business, sales and profits? And am I paying a price that makes sense for the future that I see? Investors got stupidly carried away during COVID. They got the theme right and overpaid to buggery for those shares. Because somehow, I don't know, I can't imagine what Zoom would have had to have done right. 2020, when I'm looking at this graph now, the PE must have been extraordinary. They would have had to charge $1,000 a person or something. It was just stupid, right? All people did was went anyway. COVID, isolation, video conferencing, up we go. We can pay any price for this because this is the future. They're right about the story, wrong about the valuation. And can I remind you again and again and again, lithium, anybody, right? Are EVs going to be huge? Yes. Are batteries going to be huge? Yes. Does that mean every lithium miner is worth paying $1 squillion for? Absolutely and completely not. No, absolutely not. So I own Adore Beauty. The Adore Beauty thesis plays out if and when they scale meaningfully, taking advantage of people's desire to shop online, and they build a brand for themselves as a retailer of choice for those people. I think I own the shares. I think they're doing a pretty good job of that. Not as good as I'd hoped, frankly. I would sell the shares if they were still at the price I bought them for, but they're cheaper. And that's what I was saying about corporate travel, right? Doesn't matter where they've fallen. The question is right now, do they represent attractive value for the future that I see? I think for Adore, yes, is my personal. Now, I own shares. It's a recommendation of ours at Motley Fool Share Advisor. There's a free stock tip. I think on balance, e-commerce will grow massively over the next 20 years. If Adore can maintain share and grow share, it should do okay from here. Zoom, I think at 17 times earnings is pretty good value. Be careful of potential threats. Does Microsoft Teams take over? Does ChatGPT have something? Oh, goodness knows, right? So there's always going to be threats in the IT space. But 17 times earnings for a business that, as Adam said, we use every day, we wouldn't be without. Our business doesn't function without it. I'm sitting in my home office. Adam, I'm seeing your background, mate. I don't know whether you're in the office or at home. Either way, we're doing all this on Zoom. We're meeting on Zoom. I record the Motley Fool Money podcast using a Zoom-like bit of software. Video conferencing will be the future, bar none, right? And globally, we'll only get more global over time, despite all this deglobalization rubbish talking about at the moment. So I like Zoom. 17 times earnings, would I buy it? I might. Haven't done enough work to decide whether I'd buy it for my own portfolio, but I like the business. I think it's a really strong business. It's got a really solid franchise. I think it's got a pretty attractive future. My question would be how much growth is left in it, both price and profits. I'd have to check that first. But 17 times earnings, hard to hate.
Very good. And yes, I am in the office, Scott. If I had this background colour at home,
You're off screen at the time, and I was like, I can't remember what colour was.
The wife would not like that. Yeah. Motley Fool Blue is not a colour that features at our home. Anyway, moving on. So another question from TC very quickly. If we choose not to be stock pickers in the ASX small cap space, what are your thoughts about using active managers like an index fund such as this is the Vanguard Small Companies ETF, VSO?
It's a really great question, TC. I'll try and do it quickly. If I say don't use active managers, I'm saying don't use stock pickers, and I'm saying don't use the Motley Fool. On the other hand, I will tell you, most active managers lose to the market. So how do you square that circle? I've called that the investing paradox, right? None of us should index because on average we lose to the market. And yet, if you can beat the market, you should. So how do you square that circle? You can't really for everybody. The challenge with, and including the Motley Fool, by the way, if you're trying to find someone to help you pick stocks, whether it's take advice from us, invest in someone else's fund, you are taking a punt that they will be able to beat the market and continue to beat the market. That's what you're doing. If you're buying the Small Ordinaries Index, which is the VSO, Vanguard Small Companies, you are betting on the market itself. So the average person who, I haven't seen the small companies numbers specifically, so I want to be a little bit careful about what I say here, because I might just be wrong. Nothing bad, just I might be wrong. Let's take away from smalls just for a second. The average fund is going to lose to the market. The average fund invested, therefore, is going to lose to the market. And so I would say on average, if every investor moved out of active management into passive, the total would be better. But there's a Warren Buffett for every loser out there, right? Or every 15 losers. So if you could find Buffett, shouldn't you invest with him? You bloody oath you should, right? You absolutely should invest in Buffett if you can. So that's the paradox here, TC. If you feel you have a manager that you feel has a justified reason, not just a claim, a justified reason that you think they can beat the market, go with them. Why wouldn't you? I invest in Berkshire Hathaway rather than buy the S&P 500 ETF, right? I choose a US example because I think Buffett's going to beat the market. He's got a track record. He's a smart investor. He invests the right way. I'm backing him to do better. If it was John Smith, would I back them to beat the market? Well, on average, no. The John Smiths lose to the market on average. And in fact, the fact that Buffett beats the market means someone else is losing because the average is the average of those two, right? So I don't have a good answer for you, mate. A good active manager should beat the market. Trying to work out which one a good active manager is stupidly hard. I'll give our guys a plug at Motley Fool Hidden Gems. The process matters. Ask yourself who they are, what they do, why they do it, how they do it, why they've got justification or belief in what they're doing. If you can do that and look at their track record and say, these guys have done pretty well over time, and over a long period of time, that's a pretty good starting point. So if you can find that in an active manager or a recommendation service, I'm not saying you should use ours, I'm just using it as an example. We have a small cap service, right? We think we can beat the market. Every small cap manager does. Only a few can. So far, we're doing a pretty good job. I'll give a shout out to Ed and the team at Hidden Gems. Do a fantastic job. So if you can find them, stick with them. If you're not sure whether they can or not, you're much better off going with the index. And I know that's a paradox, and I know I can't answer that question for you easily because the future is unknowable. Performance, track record, approach, style, frankly, humility. Can I say that? Don't go with arrogant fund managers. They're going to trip themselves up.
Very good. Well, that is all we have time for tonight. Thanks for joining us, Scott, and we will be back in the new year with more. Have a good night.
Cool one.